This is a bonus episode of the Rental Income Podcast. And now, Dan Lay.
I've got a couple of tax questions, and I thought this might be a good opportunity to do a bonus episode today and get the answers to my questions and share it with you. So there's three things that I want to try to figure out today. The first thing is I've had a few people recently that tell me that every year they just automatically file for an extension because it lowers their chances of getting audited. And I want to find out, is that true? Is avoiding an audit just as simple as filing for an extension? So we'll get to the bottom of that. The second thing is we've had a few people on the podcast recently that are making large amounts of money and they're legally not paying any taxes. And I want to get a better understanding of exactly how that works. So we'll talk about that today. And then the third thing is, a lot of times when I'm doing my taxes, I gather all my documents and I meet with my CPA and we just do the taxes. But I want to see what the advantages are to actually having a tax plan, to actually sitting down with the CPA and coming up with a plan to pay less taxes in the future. So what we're going to do is take a real quick break to thank our sponsors. We'll come right back and we'll talk to Ashish from the investorfriendlycpa.com. It's a lot of work to find a really good rental property. And when you actually find that property, you want to make sure you're working with a lender that can get that loan closed. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender and her specialty is helping investors finance rental properties. She has a ton of loan programs and she can find something customized to you for your situation. If you want to find out more or you're ready to get started today, just go to ridgelendinggroup.com. That's RIDGE lendinggroup.com. NMLS 42056.
Rental Income Podcast.
Let's start off talking about the audits. So this is, I think, kind of interesting, but in the last week, I've had two people tell me that every year they just automatically file for an extension because they've been told that that lowers their chance of getting audited. Is that true?
Just filing earlier, I don't think it impacts that much. It just, if you file, let's say January, and let's say out of 500 million tax return, only 20 million has been filed, you're in a very small bucket and your chance of getting picked is very high. Rather than you wait until October when all the tax return has been filed and you have 500 million tax return they have to pick, and it's a lot lower.
Okay. All right. So bottom line, so this is true that you have a lesser chance of getting audited if you file an extension. That's
what the revenue agent told me. And IRS is as mysterious as they can get.
Yeah.
So that's what they told me. And I've been following that. It has helped, honestly, because none of my clients have been audited. And hopefully that stays. But okay. I would agree with you.
Okay. All right. Awesome. All right. That's a great little trick. Now, is there anything else that you can think of or tell us about that we can do to prevent an audit? Like I know that if you took the home office deduction at one point, that was an audit flag, but then now it's not. So is there anything else that if you do, there's a good chance you're going to get audited?
I always say, don't fear of it. Don't try to do wrong stuff and fraud, tax evasion, and all the frauds. You'll get screwed because at some point you might get audited. Again, the chances are low, but you lose your sleep and you never can sleep. There are things like home office and taking auto mileages, all those things cannot just trigger audit like that. And this is what they told me, because audits are random. They will flag some returns for a higher chance of audit because it has millions of dollars of losses for the last 3 years and you have not been paying any taxes. Then I think they get in a different pool to get audited. So you're naturally highly like to get audited. That's a given. But normally just simple returns and rental properties where you're taking normal deductions, taking home office, that would not be a reason for audit.
Okay. So nothing to be afraid of. Okay. All right. Now, let me ask you, we've had a few people on the podcast recently that have said that they're making large amounts of money and they're legally not paying any taxes. And one case that really comes to mind is we had a guy in the podcast that's making $1 million a year in rental income. What do you? And I realize you haven't seen his returns. I realize you're not his CPA, but what do you think some of the things what do you think he's doing to avoid $1 million in taxes?
Yeah, it's very normal. And this is not a one. I mean, I have clients who have more than that and pay zero taxes. It's very simple. And this is what we have been, building on in other podcasts that we have been talking on, right? This is where every rich people. This is what every rich people is also doing. Wealthy people who have a lot of income coming in. Now you specifically said rental income, but this can apply to business income. Your podcasting income, any other kind of business income, you can offset almost 100% of it. You get limited at the W-2, capital gain, interest, those kind of income. They have some limitation, meaning a married taxpayer can only offset up to $500,000. Single. Around, okay, it's 580 right now, I think, but around 580. So if someone comes to you and say, I have a W-2 employee, I'm a W-2 employee, I make $1 million, can I offset entire $1 million? No, you cannot. There's a limitation. But someone like him, rental, and it's I'm sure it's $1 million cash flow, it's a business. He can offset the entire thing. Even if he makes $3 million, he can offset the entire thing. It's possible, very simple with depreciation. Everyone knows about it. If you're a rental investor, I hope you know about this. With $1 million cash, he's probably recycling his money, putting it back into the market, buying bigger, better properties. And as soon as he does that, if he buys a $5 million asset, so this guy, I'm giving a very simple example. This is what's happening. He makes a net, let's say his net taxable income is $1 million. This is amazing, right? Mm-hmm. After everything is paid off, he makes $1 million net income. What he can do is, let's say, he's probably going to buy bigger property. Let's say he buy one big commercial mall or strip mall area, which is worth $5 million. He goes, buys that, and he does cost segregation, and he gets to write off $1 million from that mall against his rental income. So when he is building his long-term wealth with real estate, he's also not paying taxes on $1 million, which he would probably have paid $300,000-$400,000 in tax. So basically saved $400,000 by buying another asset, which is also building his portfolio. It's that simple. There's nothing complicated about this.
All right. So he's buying properties and then getting a cost segregation study done so that he's able to increase the amount of money that he's able to, increase the amount of depreciation he's able to take.
Exactly. So buy a property. If you do cost segregation, you can take bonus depreciation and other kind of accelerated depreciation the first year. That saves him $300,000 in tax, or $400,000 if he's in higher tax state, let's say. Then that $400,000 he can put right back on the property as down payment and repeat this again, right? So that's why these investors and real estate investors keeps on recycling the money which they could have paid to the government into their own portfolio and pay zero taxes. It's insane what you can achieve if you can do this.
Really incredible. And you've got several clients that are doing this exact strategy.
Oh, for me personally, we are syndicators ourselves, and we buy big commercial properties, and that property would directly offsets millions in taxes. I'm not even kidding. So you're right. This happens every single day. In any real estate CPA, I'm sure you talk to, 100% of their clients are doing this, and it's not even that level. This year is, and if you want to talk about tax planning, long-term tax planning. If people have not filed their 2022 taxes, and they're waiting to finalize few things, they should also consider doing cost segregation on their long-term rental, not just short-term rental, long-term rental. Even if they don't qualify as real estate professionals, or they cannot release the losses under passive activity loss rule, they should consider doing it because it has a long-term tax planning effect. And we have talked about this before, so I don't want to go over this, but this guy is doing exactly what everyone should be doing anyway, but he gets to offset $1 million. Not everyone is going to have $1 million, obviously. So it's not any CPA, decent CPA can help you achieve this.
That's really incredible. So let me ask you about planning. I feel like a lot of people just gather up their tax returns or get their tax receipts and their documentation, and they just send it over to their CPA, and there's no real thought that goes into it.
Yeah.
What do you think the benefits are of having someone that can actually sit down with you and come up with a plan? Like, is that something that people do? Like, do they actually come up with a plan so that they can take steps throughout the year that are going to benefit them the next time they file taxes?
Oh man, I cannot tell you how important that is. And this is the thing. Not everyone is going to understand this because not everyone is paying, $100,000 in tax. But whoever is paying, $50,000, $60,000, $70,000 in total tax. I mean, when I say total tax, this is what people don't understand because taxes are complicated, right? When you go file a tax return, you might owe $3,000 and they'll be happy, I didn't owe that much. But in reality, if you look at your paycheck and actual tax return, and if you understand your tax return, what's happening is you have already paid $50,000, $100,000 during your paycheck periods, right? So you're actually paying $100,000 in tax, but people get confused with $3,000, what they have to file and pay during the tax filing period. Now, why it is important and what can be done is absolutely amazing. I'll give you two examples because most of the tax planning come at least from what we do, extensive tax planning. And what I've seen in all my career so far comes from two areas. First area is entity structuring, because if this guy is making $1 million, he could have done so much stuff, and hopefully he's already doing it, which looks like he's paying zero taxes, so he's doing it. To have a right kind of entity, so you can hire your kids, write off your vehicle, write off your home, write off your uniforms, right? And also manage some deductions like QBI deductions. So much things comes from right entity structuring. And if you do not do it right, and this is what I want you to understand, and this is gonna help your audience realize how big of a mistake they can make if they don't do tax planning in the right time. Right time is when you begin. I had a client, I get these emails and calls so many times a year, and they literally cried during the meeting. And this is what happens. They will go get a random entity, LLCs, corporations, and start moving properties in and out and put them in there. And when they go refinance the property, or when they have to buy out their partner, or they have to, things like that, they will pay $300,000, $400,000 in extra tax, okay, extra. They could have not even paid, avoided completely, just because they had no tax planning done, entity structuring done when they were starting out. And people say, oh, I'm just starting out. I have 2 properties. I'm just going to make it very easy and slow and not work with CPA. That would be a biggest mistake. You can actually, it's better to work with a CPA when you start out, maybe make some investment with him, pay the money to have right entity structure, you can scale, and then maybe don't work with him once you know everything. That's how you should be doing it. That's the first example, right? The second example, entity structuring is fine. The second example is even more important. Real estate. How big of the property should you be buying? How does a new law change in bonus depreciation affects your threshold? Because people go and buy property without knowing, okay, how much it can save you taxes, how much cash flow is going to get impacted. Every single call with my clients, I always keep on repeating, okay, for this year, if you want to offset $500,000 of income, this is your threshold. These are the kind of property you should be buying. If you buy storage units versus single family house or RV park, these are the threshold you should be buying, so that they can go make informed decision and build their real estate portfolio in a way that they are not even paying taxes and recycle the money that we talk about. You will grow 10 times faster if you have a good tax plan in place and come and have that 50 grand back, because you can scale up so much faster in a right compliance heavy way. Because tax planning has one issue about tax savings, but it's also about being compliant, not getting audited, and then not screwing and down the road paying $300,000 extra tax. Does that make sense, Dan?
That does. That really does. I feel like just a lot of people are, and I know me personally, I'm probably leaving a lot of money on the table by not coming up with a plan and not doing things right. So if anybody's in that situation and maybe they want to reach out to you and set up a time to come up with a plan or to have you answer any questions. Yeah. What would be the best way for someone to reach out to you?
investorfriendlycpa.com. There's a form you can fill out, and we will reach out to you saying, hey, let's schedule a call. On my first call, if I'm very generous with my time, then I will just give them just like planning. I'll do the planning in first 20 minutes. We have a system in place. I can do this very, very quick. I can tell you, hey, this is what I used to focus on 2023 and future, and depending on what's happening, I give them everything on the first call. I don't even charge them. I do that because I feel being an investor myself. I know how much complicated taxes are for non-CPAs, and then they just screw their investing. And I want people to invest in real estate. So what they want to do is just type investorfriendlycpa.com and you'll find me, or Google me, or email me at info@investorfriendlycpa, just saying, hey, I want to schedule a call. I'll reach out to you. info@investorfriendlycpa.com. Email me, and I'll respond personally to every one of them.
Ashish, as always, I really appreciate you coming on the show to help us out and share your tax knowledge. If you want to reach out to Ashish, it's investorfriendlycpa.com. Thank you so much for checking out this bonus episode. My name is Dan Lane, and this has been the Rental Income Podcast.